Hi there and welcome to the Macro Minutes for this week, the 30th of April. I'm your Head of Trading, Mark Gardner. We'll firstly go through the formalities, disclosure statement. Information in this webinar, it does not constitute financial advice or professional advice. It is general in nature and it doesn't take into account your specific circumstances and should not be acted upon without full understanding of your current situation and future financial goals. Okay, so stocks in our universe this week, S32, OML and RZI. We'll start with S32. So they released a positive third quarterly update in the last couple of days. Net cash increasing from 242 million to 517 million. So that's about 110% increase there. As part of an update, S32 didn't downgrade production guidance for any commodities that they mined, while they upgraded the guidance for their manganese ore production out of South Africa by about 10%. S32 also upgraded production guidance for silver, lead, zinc and zinc equivalents out of the Canyon facility, again by about 10%. So we've seen some of those precious metals start to rally a little bit in the last week. Although I think they did pull back yesterday, but they're starting to show some pretty constructive signs technically. Gold, I think, rallied back to around about 1800 before pulling back a touch, but definitely technically showing some signs of life. Silver tends to follow that as well. So the company also, year-to-date, production records at Brazil alumina mining, at 1,049 KT of alumina in the first 9 months of this financial year. And also set a new year-to-date production record at Australian manganese mining, 2,600 kWmt of manganese ore so far this year. Look, it's around about 292 at the moment, and the technicals do look constructive on this stock. So definitely one to look out for. Next up, we've got OML, Omedia. This is actually a new investing division recommendation as of this week. It was released on the 27th, so a couple of days ago. Media is an out-of-home marketing company with a diverse product portfolio, including billboards, digital screen displays, static panels. They're in a lot of geographical locations as well. So just with the general theme of consumer and business confidence on the rise, the investing department's view is that the broad-based out-of-home advertising market will recover quite well. So it's one of these reopening trades. Commute, road, retail and fly venues are all expected to increase, though the fly revenue will be slower due to the recovery in international travel. Obviously India not helping with that this week. I think flights have been banned from there. But realistically, we weren't looking to restart international travel within the next year anyway. So I don't think that would be very unexpected from investors. And the fact that will slowly restart actually serves as a fairly good long-term catalyst. So it should provide some increasing revenue in incremental amounts over the long term. So in retail. Who is leading the industry. It's got increased demand in digital advertising assets, and they've made a couple of strategic acquisitions to increase its weight in place-based street furniture and retail digital products. However, there is one sort of the main risk for this recommendation, other than sort of delayed vaccination rollouts, which could affect the fly sort of venues, comes out of sort of contract renewal risks. It's not a huge risk. It's only 20% of contracts set to expire in this calendar year. And if we saw any slowdown in economic growth, which would be unlikely, however, if there was any slowdown in economic growth, we could see less advertising revenue earned. Next one we've got up is RZI, Raise. This is a current small caps division recommendation and also a trading department recommendation as well. The trading department's only holding about 70% of its position at the moment after cutting out 30% at 190. So on the 28th, which is 2 days ago, RZI released a Q3 update announcing its funds under management was just shy of 700 million at the end of the quarter. And that's about an 87% increase on the previous period. It remains on track to reach that 1 billion funds under management by the calendar year. In fact, it's absolutely more than ahead of schedule in regards to funds under management. Australia still remains its largest source of customers, accounting for about 63%. But there was 11% growth in Australia, which was slightly disappointing. But the Indonesian segment, which is 24% of Razor's customers, grew by nearly half. So Malaysia not far behind at 13%. They grew about 45%. Normalised revenue was about 3.1 million for the quarter, which represents 40% growth, or just shy of 40%, on the Q1 2020, and 26% rise on quarter growth. Their staff costs were up by about 42%, and their production manufacturing, which is an accounting term, but they're basically their software development costs, I suppose, were up around 20%, resulting in a net operating cash outflow of 717 million. This loss was primarily driven by the Asian expansion, including platform refinement, product development, CAC and one-off costs. On that same day, Raise also entered a trading halt, which they're still in currently, which should only last for the remainder of the day. They may come back on this afternoon, but unlikely. But it's a 2-day trading halt, so worst case scenario tomorrow morning. They announced the acquisition of a company called Super Estate. Super Estate's a niche integrated superannuation and Australian residential property investment platform. This really diversifies Razor's products offering and sees RZI enter into a new vertical within their industry. So it looks like they normally have those monthly updates on the 3rd. Obviously, this has now come out two odd days ago, so that'll be less important. But at the moment, and it's very early days, it is matching up about 5 cents at 171 on the current volume in the market. And when it was halted, it was about 165.5, which is around the low of the recent range. As I said, 190, 191 was the recent high. I think we've got the price target there on that one around about 223 from the small cap division, and a trailing stop with a half price, with a half target at 223 also for the trading department. So trading departments were sort of willing to let some run. That price target is at the lower end of the range. Obviously, we may adjust that price target up in light of this recent acquisition, because we do see it as a positive. Rightio, stocks to watch out for. Basically, we're looking at US earnings season again. We're going to look at Pfizer, Uber, and Berkshire Hathaway. So some pretty big dogs there. Pfizer's expected to report first quarter earnings on the 4th of May. In a year where Pfizer's become much more of a household name, being one of the leading providers of the COVID vaccine, Pfizer's earnings will be keenly watched by investors who might see the stock as overvalued. PFE currently has a PE ratio of around 22.5, which sits well above the historic PE ratio of 15. This is actually roughly around the same sort of disparity for the general S&P 500. I think historically the PE ratios on average are around about the 23 mark, with a historic of around about 15 as well. So it could also apply that argument to the broader market. But back to PFE. It's currently in Europe. The European Commission President Ursula von der Leyen said last week the European Commission will soon announce a new agreement to buy a further 1.8 billion doses of the Pfizer vaccine. This agreement will be delivered through 2023 and secures 4 shots for every EU citizen. Though only 2 per person will be needed, it remains unclear as to what will happen with the excess supply. Pfizer has come out with a guidance saying that there may be a requirement for annual booster shots, so that may be some of the reason there. And obviously, I guess there'd be some issues there with the vaccine expiring as well. So. But look, the pricing's yet to be confirmed. The Bulgarian Prime Minister said in early April the new contract will see each shot worth about $19.50, or 19 euros and 50 cents, which implies the total contract the 2 companies would split is roughly about 35 billion euro, which is quite significant. Next up, Uber. Right, now Uber, this won't be a good one, but Uber's expected to report Q1 earnings on the 6th of May. Currently, analysts are estimating a loss of around about 37 cents a share, which if met would represent a fifth of the loss that the company experienced during the first quarter of last year. Last earnings report in February saw the company underperform expectations, with a larger than expected fourth quarter loss, and they missed their revenue targets and estimates. Obviously, I dare say that the market really doesn't expect Uber to shoot the lights out at the moment, given the pandemic and the vaccine rollout. But as the US economy's recovered, the cost of the rideshare services in the US and delivery charges for Uber Eats and other gig economy companies have been on the rise in recent months, with analysts optimistic that rideshare levels will return to pre-pandemic levels soon enough, at least in the US, which is Uber's largest market. Company's also made a few acquisitions to allow for grocery and alcohol delivery, which now looks likely to turn its first ever quarterly profit by the end of the year. Right now on to Berkshire Hathaway, so for all the Warren Buffett fans out there. Expected a report on the 7th of May. So far it's enjoyed a very strong 2021, outperforming the S&P by about 6%, so up 18% versus 12% with the S&P. This comes after 2 poor years for the company. Everyone obviously probably knows, it's run by legendary investor Warren Buffett. They underperformed the market in 2019 and 20 by an average of about 17%. It's pretty standard for value investors in a growth investing cycle. Berkshire Hathaway had these same issues through the tech bubble, etc. They're an extraordinarily long-term sort of company or fund. So yeah, that's really not out of the ordinary for Berkshire Hathaway to underperform in that growth environment. It is interesting to see that the value investing starting to pay some good dividends though. So that's something to keep in mind in regards to where you're putting your money in, over the next year. They've ramped up their share buybacks in the second half of 2020, repurchasing 18 billion in stock in the second half of the year, up from 7 billion in the first half of the year. Investors will be interested in the buybacks in the past quarter. The strong performance of the company's stock, current estimates indicate buybacks of around about 5 billion in that last quarter. Okay, moving on to looking ahead to next week, economic data. So we've got RBA next Tuesday at 2:30 as per usual. We've got ISM manufacturing next Tuesday as well, so Wednesday morning that is. And at 10:15 on Wednesday night, we'll have the ADP non-farm employment change. It's been a loosely useful figure. It's been quite volatile and hasn't really been a great lead indicator for payrolls lately, but traditionally has. So obviously the ISM manufacturing PMI figures are released on that Wednesday morning. The Institute for Supply Management, it's a leading indicator of economic growth, and given the businesses are purchasing managers of those businesses, basically they're a leading indicator or very quick to respond to market conditions. We did have a few companies saying this week on some preliminary numbers, some smaller numbers in this field, saying that they're going to start, the rise in commodity prices is really starting to hurt margins, and they're going to start passing that on to the consumers pretty much as of immediate effect. So we might start to see some inflation peak its little head up over the next quarter potentially. Moving on to the RBA, look, there won't be any forecasted change, particularly now that CPI came out yesterday with only up 1.1% for the year. That really gives the RBA a huge amount of breathing space in terms of announcing whether they need to be tapering QE. I dare say they'll probably try and keep it fairly low key, given that inflation number, releasing the pressure. There was some initial banter from the Bank of Canada in regards to QE tapering last week. I dare say they're not particularly popular with the rest of the central banks because it's something that they don't want to become a common thought, because basically it has a very small chance of derailing any sort of economic recovery with interest rate, bringing forward interest rate hike expectations. So the Bank of Canada won't be particularly popular there, but it was largely ignored. Bond yields actually came off on the back of that, to be honest. So it was largely ignored. And that pretty much wraps up the Macro Minutes for this week. Thanks for listening, and we shall chat next week.